Michael Burry predicts the stock market will experience the most significant decline in its long history. People in the United States of America are still struggling to keep up with the rising costs of everyday necessities like food and clothing. People in the middle and lower classes feel the burden of the current inflation. Investing in stocks and bonds is common among the wealthier members of society who are concerned about their assets depreciating. When the stock market goes down, who is most likely to be affected? To learn more about how the global economy is affected by the financial market, subscribe to the Dinero Association YouTube channel. We will be posting videos frequently to ensure you don't miss a thing. Michael Burry believes the stock market will crash. Michael Burry strongly believes that a massive crash in the stock market will occur. He even changed his Twitter name to Cassandra to assure that he had warned everyone about this possibility. The Greek mythology character Cassandra is a prophetess. Her fate was to spend the rest of her days begging people to believe her when she said she could see into the future. Burry now predicts the most significant market decline in history. Burry was able to achieve annual returns of more than 26% throughout his 13-year career as a money manager by correctly anticipating short-term outcomes. GameStop's expansion was forecasted before the dot-com bubbles demise. Everyone knows that the market is at an all-time high and that there will be a crash. In a tweet, Michael Burry said that the S&P 500's nominal price over earnings ratio is 26 and Shiller's CAPE is 39.23. Before 2008, the S&P's PE was 18. Before 1929 to 1932's 80% crash, it was 20. Before 1973 to 1975's 48% crash, it was 19. This is the price-to-earnings ratio of the S&P 500 when inflation is not taken into account. Because the S&P's current PE ratio is higher than it has ever been, even if you go back to the 1800s, it is clear that it is above all previous records. It's different from the S&P 500's nominal PE, which doesn't account for inflation over the last 10 years. The Shiller CAPE ratio has climbed all the way to 39, which is a very high number. Only during the dot-com bubble did the Shiller PE ratio go above 44. How the market is thriving. Only a handful of people can predict with certainty when the stock market will implode. Michael Burry is convinced that he knows what will happen. Over more than a year, the Federal Reserve has been printing a lot of money. Since then, inflation has continued to rise, with October's Consumer Price Index inflation rate of 6.2%. According to the Fed, this inflation is temporary, but Burry identified a statistic that disproves that. There has been a decrease in the reopening components while energy and non-reopening components have grown. This suggests that inflation may not be as short-lived as the Federal Reserve claims. Despite the reopened demand having faded, inflation is still rising. Inflation is soaring, yet earnings in the United States are still not keeping pace with the rising cost of living. Michael Burry tweeted in mid-February that the stock market is dancing on a knife's edge. The market crash is walking closely to reality as the S&P 500 index continues to rise. Michael Burry's passive investing's IQ drain worsens the problem of a widespread movement of assets from active to passive index funds. Small-time investors investing in equities are jumping into the market at an alarming rate, and current events appear to be increasing the risk. GameStop stock rose from less than $20 per share to $480 per share in less than 30 days. then fell down to around $50 per share. Michael's $270 million profit on the sale of GameStop's asset is particularly relevant. GameStop is a retailer based in the United States that offers video games, consoles, and other electronic devices. The company's fortunes were bleak due to the epidemic, and most games were sold online. Frequently, investors speculate on which businesses will fail in the future, selling the company's stock to repurchase it at a later period. To gain a profit, you would repurchase the company at a discounted price when you anticipate it will lose the value. Michael Burry's prediction: inflation almost always has the same effect on poor or middle-class people. Both taxes and government spending cut our purchasing power. On the other hand, inflation does so in a more subtle way. On the other hand, most people in the upper class know a lot about how to protect their money from inflation with assets. People who buy things for their own consumption have been coming in over the last year, so that's changing. Since January 1, real wages in the United States have gone down by 2.2%. This seems to be the only thing that's important about this crazy, frantic year. On a large scale, inflation is a tax that is unfair to people who earn less than other people. Inflation is wreaking havoc on people in the middle and lower classes right now. This is because inflation is just another way to tax people. It costs us money to pay taxes because the government takes money from us, lowering our wages. According to Michael Burry, the influx of new investors has fueled speculation. The most famous example is Rivian. Even though it hasn't made a dime yet, it was recently valued at over $160 billion. I suppose ICE will be broken up. Burry believes Rivian is the pinnacle of conjecture, and that the most tremendous crash in human history is imminent. Rivian is California-based electric vehicles, EVs, and automotive technologies. It has introduced itself as a major player in the electric vehicle industry, distinguishing itself with a concentration on heavy-duty vehicles and raising more than $5 billion in 2020 and 2021. How well are you preparing if you think you are among the market players that could be affected by this crash? Please share and like this content and let us know what you think by typing your comments below. Keep your notifications open and I'll see you on our next video.